The war in Iran shows no signs of cooling down, and neither does inflation. Consumer prices in the US jumped to a three-year high of 4.2%, propelled by soaring energy prices. And that was a jump of 0.5% compared to April, the first time consumer inflation has crossed that 4% threshold since May 2023. It's a similar story for manufacturers in China. Those sky-high energy costs pushed producer prices up 3.9% compared to a year earlier, their highest level since July 2022. But the picture changes as we move from the factory floor to the shop floor. Consumer prices in May rose just 1.2% compared to a year earlier, led by gasoline and gold jewellery. Marc Ostwald is Chief Economist and Global Strategist at ADM Investor Services International. Great to see you, Marc. So are we looking at two very different inflation stories in the US and China?
Yes, to a certain extent we are, because underlying core CPI in the US is running around 2.9% as against 1.1% in China. And when one looks at the producer price data in China, it's very instructive, because you've got the pressures from energy prices, 15.8% up for mining, raw materials 9.2, even manufacturing 2.8, and then you look at the subgroup of consumer goods, and it's still a negative territory at minus 0.8. By contrast, in the US, you've got core inflation running at 2.9. It was slightly better if you exclude the housing component, but it's still running at 2.4. That's above the Fed's target. It's not a game changer for the Fed, but it certainly shows that demand is keeping inflation relatively buoyant in the US, whereas demand in China, particularly domestic demand, outside of the pressures related to the Middle East conflict, is really quite subdued, particularly when one considers there was quite a big boost from base effects from last year.
Well, you talk about domestic demand. I mean, so what about the Chinese consumer? Are they going to eventually feel that factory floor price pressure that we're seeing now?
At the moment, all the evidence points to actually the people who are going to feel it most are manufacturers, because they're struggling actually to pass on the higher input costs. Yes, there will be some pass-through, but I rather suspect, given the low level of domestic demand, that there will not be that much. So really where this is going to hit is in profit margins.
Now, let's go back to those US numbers, because are they facing a broader inflation problem, do you think, or is it still mainly all around energy?
The services inflation is still running quite hot. It's around 3.5% year on year. It's slightly better than it was, but the scope for pass-through, I think, is much stronger in the US. And one has to remember that for the time being, given domestic demand, consumer demand it's a very disparate picture between high earners and low income families. Low income families definitely feeling the pinch here very hard, but and particularly in what I would call non-discretionary areas. But for high earners, the demand is still there, and it always takes time for these sort of energy costs to feed through outside of airfares, which is obviously a big contributor to the inflation that we've got at the moment, running at about 26.7% year on year, which in a country like the US, where everyone flies, does actually have a fairly substantial impact. The pass-through isn't there yet, but the second part of the year, more than likely.
Just very quickly, because you mentioned that all-important Fed meeting next week. Do these numbers make that meeting a bit awkward?
It certainly means they're going to have to sound a warning bell that if there is further evidence of pass-through, they will have to hike rates, and that's quite a seismic change from the messaging over the past 3 to 6 months.
Marc Ostwald, thank you very much indeed.